Welcome, welcome, welcome. All right. So I'm gonna give this now 6:03. I'm gonna give it about 2 more minutes. We'll get started at 6:05. Appreciate you guys for tuning in. We can go ahead and get started in about, like I said, about 6:05. You can bear with me for a brief moment. All right, so it's 6:05 and we are live. And this is turning liabilities into assets using the infinite banking concept. If you are not currently using this concept, I strongly encourage you to go ahead and hop on this concept here. Essentially, what I'm going to talk about today is being able to take different expenses like our mortgages, our rent payments, credit cards, um, personal loans, student loans, any type of expense that we have, whether we're trying to pay it off or if it's something that's recurring like an electric bill that they never stop coming, unless you have solar or something like that, but not gonna get into that. Um, but that's what we're going to talk about, being able to take these expenses that we have and turn them into a profit, turn them into an asset, something that once I make this payment, I'm actually excited because I know what's happening in my account when I make this payment. So let's go ahead and get started without further ado. Here we are. All right, so the first thing we're going to talk about here is the banking flow chart. I'm going to take it a few steps back. So, first and foremost, we're all depositors, myself included, because I do currently have a banking account. I don't put much in my savings, but I do have a little bit set aside for a rainy day type deal. But anyway, as a depositor, when you have your money in a savings account, we're actually lending that money to the bank. And the reason I say that is because they take other people's money and they leverage it. This is what banks do. This is how they're able to stay in business and how they're able to create more money. So they take our money and they invest it into stocks, invest it in the bonds and the real estate. You see a lot of properties. Most properties are owned by banks because they're able to go out and take other people's money and multiply it. And they also take it out and give it to other people in the form of loans. And those people who get those loans, they have to pay the bank. So they're paying the bank high interest fees. And then the bank gives us in return lower interest rates. So what I'm saying here, banks are great. Banks are amazing. But as far as a building of cash flow and cash accumulation, banks might not be the best vehicle, in my opinion, for building your money, unless you're a billionaire and you're able to. If your CD account earns 2% a year and you put $1 million in there, then yeah, you're going to be pretty nice. Then yeah, that's going to be pretty nice. So you definitely want to make sure that if we're putting our money into any type of vehicle, we want to make sure that we're getting a return. You want to get that ROI, a return on your investment when you're putting your money into something, and you also want to be able to have that liquidity. So that's what banks provide. They provide liquidity. So that's why we put our money in a banking account. But one thing that banks don't really provide is the interest rate. They provide it for themselves. They earn it. They get money paid back from a loan, and they get interest paid back from stocks and bonds and real estate. But they're not actually paying that out. They're keeping all those profit for themselves. So now we're going to talk about building our own bank. But before we get to talk about talking our own, building our own bank, one thing that we typically invest in, typically if you're working for an employer, if you're working for some type of business, um, they have you invest in an IRA or a 401k type plan, or even a 403b TSP pension plan, whatever the case may be. They're going to have you invest in one of these plans, and you're able to invest outside, of course, but usually they have you invest in one of these plans. Most of us may not know that these plans are taxable, for one. So what that essentially means is, even though you're not getting a tax rate then, it's tax deferred, it's tax delayed. So yeah, your taxes aren't hitting now, but once they hit later, it's going to be a much bigger portion of your taxes, to the tune of 30 to 40% of your taxes, excuse me, 30 to 40% of your earnings going away in taxes. So I'm gonna say that again, 30 to 40% in taxes. So before you even get to touch your money, 30 to 40% is automatically being taken out. And that's just not something that I'm going to subscribe to. That's not something I want to be a part of, having 30 to 40% of my savings. Next, you have market volatility. When the market goes up, it's doing great, obviously, but we know what goes up must come down. What goes up must come down. So if it's going up, then that's great. But when we lose money, it takes more money to be able to make money that you lost. For instance, if I have $100 and I lose 50% of my account, I now have $50. If I earn 50%, I only have $75. So I have to make 100% just to get back to break even what I already had. So that's what happens. And if your account is constantly up and down, up and down, yes, you may be earning over time, but you're also leaving money on the table. So the next we have is government penalties. So if you do need to access your money and need to use your money for any type of purpose, unfortunately, with these type of plans, you're going to have a penalty. You're going to have to pay an extra tax just for having a touch of money. So if you need, $10,000, that 10,000 may turn into 30 to $40,000 after you're finished paying the penalties. And again, I'm not exaggerating on that. This is just what it typically is. If you need to access this money, I'm sure you can people who will say, "Yeah, I need to take a loan out of my 401k." And then also, if you need to take a loan out, you have a specified time that you have to pay by. And guess what? If you don't pay it, taxed. Another fee that's basically taking money from you, not giving money to your future self. And lastly, you have Wall Street fees. So any type of investment plan that's on the market, anything that's tied to the market is going to have Wall Street fees. You can't avoid it. That's like a consulting fee. It's like a admin fee. That's just something that you can't get around. So that's just one of those things that you do have to deal with. But it's something that's taken away from your money. Now, the reason why whole life insurance is so powerful, for one, it's been kept a secret. So a lot of times that things that can really kind of be a game changer that seem to be kept secret. And this is one of those things. This is what allowed Walt Disney to create Disney World. He went to different banks, and the banks were saying, "Hey, no, this is too much risk. We can't pay you for this." We can't give you this money. So he took the money out of his life insurance policy and he did it himself. Yep, he was able to do that himself just off of his cash value. And the reason why he was able to do this is because all the cash value that's inside of a whole life policy, for one, is tax free. It's taxed once the money has gone in because it's coming from a income source. So that's the last time it gets taxed. Once it goes into that policy, it's not taxed anymore. It's penalty free, which is key because, like we were talking about with the 401k, if you need to access your money before you're 59 and a half, you're getting taxed. With this, if you need to access your money next week, you're good. You can do that. That's the power. That's the power of this. Now you're able to have your money flow for you. Because if your money's not flowing, it's not growing at the end of the day. If your money just flows into your bank account and it stops there, you're not doing anything. This is giving you a vehicle so when your money flows, it's consistently growing, whether you're using it, and even if you're not using it, it's still growing for you. So once it continues to flow, obviously, like I said, it's going to grow. Last but not least is risk free. It's not tied to the market. You have guaranteed earnings. So this isn't something that say, oh, um, oh, that looks good, but when I get the policy, it didn't really do that. No, it actually, these are guaranteed earnings. So everything that you see, the numbers that are ran, this is something that you will have as long as you stick to the plan that is put forth. Now, the reason why this money is tax free inside of a cash value policy is because of the rule you see there, IRC 7702. Essentially, what that means is that any type of money that's inside the policy is going to be tax free, and the money that goes to your family, should anything happen to you, is tax free as well. Yes, at least. So that, like I said, very powerful stuff. This is something that's a game changer, and it allows you can see how it allows families to continue to build wealth. Can even It's even like a income uh, hider, if you will, because this isn't something that's going to be reported. This is, it's just cash value in a policy, but you still have access to it. I'm sure you're like, all right, Derek, but the policy I have, how am I even able to, that doesn't make sense. How am I able to access this? How am I able to do this? What are you talking about? So what we do is we take the cost of insurance. You take how much the insurance is going to cost and you shrink that down to the least amount that you need. And then you take the cash value and you're going to extend that as much as you can, that it doesn't interfere with the insurance, because the insurance is what allows it to be tax free. But we want the savings because we want that to multiply. The more money is going to make more money. So if you have more money going to insurance, you're not doing anything. You have more money going to the savings that's building money for you. So looking here, you have automatic fixed growth of 2%. And some may say, oh, that's not a lot, but how much are you getting in your savings account? Now wait, how much are you getting in your savings account? You know, Less than 1%. And you might say, oh, my 401k gets more. It might, but tax deferral, 30 to 40% is coming out. Then we just talked about market volatility is going up and down. So probably not. Probably not getting as much as we might have liked. And also this includes annual dividends as well. So the businesses that I do business with, they are A rated or higher for their financial strength. So essentially that's going to guarantee you, excuse me, not guarantee, it's going to make sure that you have a high probability of getting dividends, but I can't say guarantee. So I didn't say guarantee. It's going to give you a high probability. Compound uninterrupted growth, I'm going to go over that in a second, how that works. Sorry about that. And last but not least, there's no Wall Street fees. So you don't have to worry about paying any fees when you access this money or when the money's invested, because it's not tied to the market. There's no risk. Again, not tied to the market. There's no government penalties because you can access it whenever you want, and the interest grows tax deferred. So the money that grows because there's more money in there, is going to be tax deferred. But the principal, the money that comes out of your account and goes into the policy, is always tax free. All right. So now going here, we're looking at this unique borrowing feature. So this is what makes this, in my opinion, this is kind of like a 401k, but you have access to it, but it also has saving account type capability, because you can, well, I mean, I guess it's still in the 401k aspect because you can borrow against it. You can borrow against the policy. So if I have $1,000 in the policy, let's say you have immediate access to 80%. So that means I can take out 800 immediately. Now that 20% is still growing for you. And really the 800 that you're taking out is still in the policy because of the way loans work. It's still earning interest for you. It's just that you have $200 left of cash value that you have. So that 800 is working for you. 200 is still working for 200 is still sitting there. So really that whole $1,000 never left the account, even though you just took that $800 to pay a car bill or to pay um, your mortgage or whatever the case may be. Now, every time you're paying this, what's happening is you're building more cash value and the money is never leaving your account. So you're building on top of what you've already paid in, and it's giving you more capability to buy things at a later date. There is a loan expense, though, it's 5% simple interest. So that means it doesn't carry over. And based on the way the dividends are set up, you're automatically getting 2%. You can look at getting anywhere from 4 to 6%. So really the dividends and everything that you get into the account is going to wash out the loan to the point where you don't have to pay for it. And the beautiful part about it is if you do want to pay for it, then that just creates more cash value. If you don't want to pay for it, and let's say that something were to happen to you and you weren't no longer here, the amount of death benefit that you would have would be so much larger than your cash value that it wouldn't even matter. It wouldn't even matter. And like I said, those are numbers that I would run, but it wouldn't even matter. That's how I set the policies up. So it gives you the cash that you need right now to finance whatever you need, but it also gives you that security that if anything were to happen, your family will be taken care of and your loved ones will be taken care of. All right. And this is the final slide. Appreciate your patience here. We're going to go over this and then we'll be all done. All right. So go here. All right. And I'm gonna. Okay, so if we take our savings, let's say we want to save $500 a month. That's our savings goal. As we put that $500 in a normal savings account, um, what would happen is we would have $6,000 in that year. Great. Um, so that means you have $6,000 that's earning interest for you, which ends up being about 60 cents that you earn on a great savings account. Usually you don't even get that much, but about $6,000. The thing is, you're going to get taxed on that money if it's sitting in your savings account. So we're going to say conservatively, let's say you have to pay 30% in taxes. So you're really looking at about, $4,200 of today in I should say in tomorrow's money. Yes, today you have this 40, excuse me, you have $6,000, but basically if you leave that money in there for a year, that's what's happening to it. The taxes are coming out of it. And then with inflation, it's just continuing to eat that up. Whereas if we look at putting that same $500 into a policy, this isn't even talking about expense right here. This is say you're just putting the money away. So if you're putting that same $500 into a policy, you got $6,000 in savings, just like you did in the first example. $6,000 that's earning interest for you, just like you did in the other example. The key is though, is that with the additional 2% there and the dividends, you're looking at about an additional $120, which is a lot more than 60 cents. And that's in your first year. And you have about $4,800 because remember, you have that 80% of your savings that you can have access to as far as loans or again, whatever you needed to do. If you need to, let's say you need to buy some new tires or you need to buy a new part and it's pretty expensive. Take a policy out. Let's say you wanted to go on vacation and you need a couple, quick, 1,500, $2,000, whatever the case. Your policy will do that. And when you take this money out, it's still there. So all of the money that you have is actually working for you, as opposed to when you go to a bank and you take out that 1,500, that 2 grand, that money's gone. You don't have that money anymore. You have the experience, but you don't have the money. I might be a little greedy, but I want both. I want both. So if If this brought you guys any value, if this is something that you think that you would like to learn more about, this is how we can get in touch. All you have to do is contact this number here. That's 410-803-6005. And basically, I will send you a link that'll link you to my calendar. And then once you do that, we can go from there. Or if you already have a time, say, "Hey, I'm available at this time." If it works in my schedule, we can definitely do that. If not, then of course we could just work around that. But hopefully, you found some value in this concept. I plan to keep on doing this every Wednesday at 6, and I look forward to talking with you guys next week. Actually, I apologize. Won't be next week, but I'll let you guys know. It'll probably be the following Wednesday. But either way, y'all be blessed.